Hello, everyone. Welcome to today's session. Let's jump right into it here. I have a lot going on here in the last couple of days with market conditions. Seeing pretty significant sell-off, seeing a bounce right here as well. Let's look at long-term market conditions. We're sitting right at that bull, mildly bearish in a bull market. We'll see where we close out today on S&P 500. That bull market rank sitting at 27.06, and flattening out just a little bit here. We've actually dropping a little bit. I believe from yesterday it was up above 27.15 or 27.2. I'd have to double check, but we are definitely seeing this pullback, pausing this overall uptrend, and potentially reversing back into a little bit deeper counter trend or downtrend here as well. Momentum shifting, sitting right on the edge of that bearish trend on S&P 500, and breadth also stuck right here in the middle. Sentiment, we saw a little bit of a pullback in sentiment, and that is expected for some fear to come into the market when we're getting some of these sell-offs that we've seen. We'll look at another indicator here as well. We jump over to, I'm going to skip over buy-sell ratio just because I've got a little data issue on this, and we've just about got that finalized. But one of the other places to look on buy-sell ratio is if you go to sectors and go to this sector scan and then look at this buy-sell ratio and the buys and the sells posted right up here at the top. You can see that 2396 and that 1000. So we still have that 2-to-1 buy-sell ratio, and really that's been the biggest factor. We're just seeing technology stocks, these big winners that we've seen, get beat up a little bit here. Nvidia, for example, although I did see Nvidia having a little bit of a reversal bottoming tail bar, deeply oversold on momentum in that corrective zone, that 382 retracement. So this 6-month time frame with this swing high and this swing low down here at the bottom, the momentum zone is the 236 location. But as long as it maintains an uptrend, it can really counter trend or correct all the way back inside of this box. So this oftentimes referred to as a correction box or a counter trend box, and that is anywhere from that 382 to 618. The 50% retracement line, if you think about this, it's just this high point and low point of the trend. If we go all the way from that point to this point, and then we come back halfway, 50% of that move, that's where that 50% line is. So inside of that corrective or counter trend box, 50% is halfway. That's a pretty common retracement as well. But we are seeing reaction here with Nvidia on that 382 retracement location as well. And that's that 110 zone, a possible bottoming tail bar here as well. We're seeing that across the board on markets. So now we're getting to that point where we've got momentum deeply oversold. We've got a 3-part counter trend. Now we're just talking about Nvidia. That's kind of become the barometer of the market recently, and at least on tech names. Other things are certainly working, but if we're following some of these things in tech names, Nvidia is one of the places to look. The other place to look is Russell 2000. So Russell, we've seen those tech names. We saw a rotation out of tech and a rotation into small cap. Okay, and Russell 2000 is the or the index. WM is an ETF to be able to trade that. So here, if we're just focused on Russell 2000, we can see that inside of the momentum zone is holding up. So there's momentum in small cap, and that's the kind of the place, kind of the core area that's really receiving a lot of interest, a lot of volume, a lot of momentum. It's holding up the best versus S&P 500, which has been retracing, although again, we're watching to see if we get a little bit of a bounce here, a little bit of an activity zone happening right at this support range inside of this area. It didn't really get back down to that 382, but really anywhere inside of this zone now, you've got support here and here. You've got this 382 level here. You've got this gap fill here. You've got areas and reasons for some support potentially to happen, at least a shorter term counter trend bounce if this is starting to move over to the downside. This is where we're at now when we start to feel, if you remember back here, we're talking about, hey, this isn't going to last forever. Markets are extended. we're going to get a retracement. Okay, so we're in that process now. We're in that retracement. So did we position ourselves properly for a retracement? In terms of what we're doing during that uptrend was about allocation, right? It's about position size going into a retracement. So for me, in the way that I'm managing this currently, it's 25% or less in equities and the rest sitting in cash. Okay, and that's how we can manage volatility. Volatility is nothing more than, you know, these ups and downs, these ebbs and flows. When we're trading stocks and dealing with stocks or anything that has price movement, we're going to be dealing with volatility and we're going to be dealing with risk. And there's no way to get around that. The only way to avoid that is to not trade and to sit in cash. Okay, so part of the management process is understanding how much do I want to play? Okay, how much volatility should I be taking? And that has to adjust based on current market conditions. All market conditions are not the same. Okay, every day is a different day when we're dealing with stocks. Every day is a different day when we're dealing with the economy. That's part of the fun of it, but it's also part of the management part of it as well. It's never the same. We can never just say, okay, I'm going to go with this idea and I'm going to stick to it. I shouldn't say that. One of the ideas that we could do is just say, I'm going to buy S&P 500. I'm going to add into it a little bit each month, and I'm not going to look at that portfolio for 20 years. Okay, so a really long-term idea is adding money into the S&P 500 consistently over a certain amount of time, over a long period of time, and just trusting that we're buying into America's best companies, the world's best companies over time. That's certainly a strategy to utilize. Typically, most investors, traders are doing that already in a 401k or some type of a long-term qualified type plan, a retirement plan, an IRA, diversified among a lot of different names and a lot of different ideas. Okay, so in most cases, that, you know, I would say in every case, you should have money that is utilizing that idea, because it ultimately is the easiest thing to manage. There's going to still be ups and downs and volatility, but it definitely is a viable method versus really actively trading it. Now, the flip side of that is we want to be able to trade individual stocks because we feel like we can potentially get better returns and taking a little bit less risk. Okay, so in this case, by doing that, by adjusting our allocation and that risk amount or that volatility amount, we're not going to be as subject to market risk. Market risk is simply, if the market goes up, most of the stocks in the portfolio will go up. If the market goes down, most of the stocks in the portfolio are going to go down. Okay, that is market risk, and that is if we are in the market at all, we have market risk. There's no way to avoid that unless we are not in the market. Well, we're not in the market with a pretty big chunk of the funds. So in this case, we're not exposed to market risk with 75% of the portfolio. Now, as we want to take on more risk, or we're maybe earlier or in the middle of a trend, we can take on a little bit more risk by adding more stocks and adding more holdings into that overall portfolio. And you can do it, mix and match it for whatever you're feeling comfortable with, for whatever your trading plan is going to allow you to do, so that you can have some consistency in that method and not just be gunslinging, saying, I like this, I'm going to buy some NVIDIA. You know, was at a family activity this last weekend, and that was part of the discussion. How's your NVIDIA? How, it's like, I'm not even in NVIDIA anymore because of my structure, because of the plan. It just we got out, we made some profits, we get out, now we're waiting for another reversal, versus wondering and having it be water cooler talk. That's what the cool kids want to try and do, but it's pointless. Okay, what we're in and why is what the market is providing to us, and when, and how much risk we're taking is just dependent upon the amount of volatility we can tolerate, or our suitability suggests. Suitability in the finance world is what is acceptable to me and my own personal financial circumstances. That's different than you. That's different than anyone else. Your own personal suitability is different depending on your knowledge base, depending on your skill set, depending on your assets, and depending on your ability to manage risk. Okay, but it's it's that is all part of a trading plan to say, I understand that I don't want to lose anything. I don't want to have any risk at all, or I don't want to take on too big of a position. Okay, if you as you understand yourself and understand your own suitability, then you can craft the trading plan to make it more fit in within your own personal trading plan and your own personal suitability. Okay, and that's as important as understanding the buying and selling process is to understand what kind of risk do I actually take? Do I have market risk? How much market risk do I have? Okay, how much investment risk, stock risk do I have? Okay, the slices of the pie right here are our individual equity risk. Okay, we're taking risk by owning any of these stocks because they can go down. We can lose money on any single one of these stocks. So there's risk associated to that. But because of the slices of the pie, that's called diversification. We're not diversifying among asset classes. We're diversifying among stocks and trends. Okay, we're diversifying among stocks within the current location of that trend. For example, WGS, this stock has been moving higher. We didn't own it during all of this trend. We've got into it, I believe, either on this buy signal, or it might have even been this buy signal. Okay, but it's up about 35, 40%. That is currently working. Okay, it's currently within that overall trend for that 1 year time frame. Even on the 6-month time frame, it's still working. It's pulling back here a little bit today, but at some point it's going to not work. At some point it's going to retrace all the way back down to a point that we have a stop loss in place. Okay, or during the upside, we're taking gains into the strength. Okay, so right now my trading plan is for selling 25 or excuse me, selling 50% of the position when we have a 20% increase. Okay, so if the entire holding goes up by 20%, we're selling half the position into that strength. And then if it goes up to 50%, we're selling another 50%. And at some point we will have sold enough of the position, and then we trail the stop. So we're selling into strength, but we're still trailing a stop loss along the way. And that allows us to take gains along the way, but it also allows us to make sure we're always managing the risk associated with that. There's pros and cons to that. The con is that we have a smaller position on a big winner. It really takes off because we never know which one is going to be the one that gives us the big gain. That's the downside of that. But we know where we're at in the market trend. We know that we're at the upper end of this range. We want to lock in some of the gains along the way. And a lot of traders find that to be more comfortable to take some of the gains along the way and then trail stops on the rest of the position, instead of saying, I'm just going to sell my entire position at a target and then I've got to re-enter at a different location. Instead, we're going to sell into the gains. Well, what is determining what we're selling into? Okay, what is determining that? Well, okay, it's our trading plan. As I mentioned before, if you go out here and go to this training and then trading plan and go out to this trading plan here, what's the approach? So down here, market conditions, entry rules, exit, take profit. I can sell based on the following. I can sell 25% of the position. This is 25. We can go 25 or 50% of the position at a 25% gain, selling into strength on up days. I can also sell to rebalance. If I have a position that's had a big winner and I want to rebalance it back to my original 2 to 2.5%, then I can sell just to rebalance that back in. Okay, for example, if I look, let me actually open up another tab here so I can go back to this. Okay, is if we have a position here, and right now none of these are going to be too extreme, but ASTS, you can see that number right there. It says portfolio allocation. It might be a little hard to see, but it says 2.48%. Okay, so we started out with 2%, or even less, and it's up to 2.48%. If that were up to 5% and we hadn't taken any gains, then I would sell half the position to rebalance this portfolio allocation back to 2% or 2.5% or whatever my initial capital amount was. I can sell whatever is over and above that portfolio allocation to rebalance us back to that. A lot of traders prefer that as well. I like using that method as well because it is it's not quite as it's not quite as exact or tactical to say, I got to sell at this price or I got to sell at this area. It's I got to sell based on the way that stock is reacting inside of my portfolio. That's a rebalance. Okay, so the trading plan is determining what our actions are. Number one, how big of a position am I taking? Number two, where's my stop loss? Number three, how am I selling into strength? Am I selling into strength? Okay, and what percentage and what amount. Okay, all of those things need to be structured and as a part of the overall plan. I'm kind of jumping around here a little bit, but let's go back to a few different things as far as market conditions. I want to still talk about or take a look at some of these things. We talked about technology. So here is the triple Qs. Triple Qs just getting pummeled, almost giving back all of the gains of the breakout. Okay, so our breakout pattern here of early in the summer, rallying, retracing this back, and technology has gotten the worst of it. But look where we're at. Okay, and look at that bottoming tail bar. NVIDIA pulling some support right here as well. This is not the methodology we're trading to try and pick this bottom, but if you are understanding what can happen at these locations, these can potentially be areas where we get a bounce, moves back up again. Okay, and these are some of the clues to be watching for. Are we inside of the corrective zone or the momentum zone? Momentum zone got obliterated a while back. Are we inside of the corrective zone now? Yes, we are. 50% on NASDAQ is finding some reaction. Okay, it's finding reaction because the market is showing us there's buying. We sold off, now we're rallying. So we're getting that short covering, oversold, momentum trade back to the backside or back to the upside. This is a dip buying scenario. This is what a dip looks like. Okay, this is what a dip feels like because we're in an uptrend. We're moving this direction. And the only thing that in this case, this Fibonacci 6-month time frame here and here is snapping to this location and this one. So I know that on the 6-month time frame, it's automatically going to help me find the trend. Okay, and then it'll tell me where my locations are inside of that trend. Momentum is out, corrective or counter trend reversal is what I'm watching for to see are we going to continue this bounce higher, or in this case we don't know. This trend could be broken. This market could be starting to roll over and heading to the downside. These are the potential early phases of that starting to happen. If we go out to a couple years, let me get rid of the volume here as well so we can just look at price activity. You can see that each of the last couple year timeframes on NASDAQ 100, if like on a map, when you say you are here, okay, in terms of us being here, we are either here or here of this trend. We are potentially here as well, meaning this thing could continue to slide. So once we get into those bearish trend zones, we don't want to be overly aggressively allocated into those based on our time frame and methodology. Again, someone else's strategy may be, hey, I'm going to buy all I possibly can at the low, at support. Great, that's fine. And that is a strategy and that is a method, but we don't want to jump around to different methods and say, oh, we're going to do this, or oh, now we're going to do this, or oh, now we're going to do this. The momentum style of trading is let's focus on the green. Okay, once that green starts to break down, we can go from green to yellow. Most of the time, by the time we hit red on a 6-month time frame, we will have been stopped out at a 236 because most of our trailing stops are going to be at a 236. If we bought back here or even here and it's moving higher, okay, and we're using this 236 retracement. Now, if you're new or don't know what I'm talking about, this 236 is a Fibonacci level. It's kind of covered up right here, okay, but on those, just on the drop down lines, Fibonacci levels are proportional relationship numbers, and really you could just call it 25%. You're going to be close as well. The Fibonacci, in this case, the 236 is derived from the Fibonacci number sequence. But if I said 25%, 50%, okay, those are going to also be good areas to be focused on because most of the time, once that breaks down, we want to be out of the trade by this point. There will be times where it bounces and heading is going to head back up, but in most cases, this is what ends up happening on an individual stock or a market we don't want to play. Okay? We want to be out with the bulk of with the bulk of the money because we just don't know what's going to happen at that point. Now we're getting bears in control. We're getting selling in control, at least on technology, at least on NASDAQ. And we know why, because, you know, the whole AI bubble is in force, and markets and stocks just overshoot. They just overshoot to the upside. They overshoot to the downside. Let's look at the Dow Jones Industrial Average on a 6-month time frame, pulling back to support. So here's the breakout zone, pulling back to support inside that corrective zone. So almost all markets are, other than the Russell 2000, are not in the momentum zone anymore. They're in the corrective zone, meaning we're still in an uptrend, okay, but we're correcting that. We're counter trending that. We're taking profits, or we're selling because we're adjusting. And I'm saying the market as a whole. All of these could be reasons why the market are retracing. We never know. Everyone's got their different reasons why they're buying and selling, and why they're in Dow stocks or small cap or NASDAQ or whatever the case may be. But in this case, market as a whole, it's finding support. I should say the Dow is finding support here, and at a 382 level. It's got some work to do. All of these corrective zone, retracement, pullback, buy zones have got work to do to the upside, okay? And that creates an area where we can watch it and say, how is it going to react here? Okay, is it going to create resistance where it can't break through that and it ultimately rolls over, retests this zone, can't, and then fails and then moves into that next zone? Okay, now we know that we're stair-stepping the wrong direction. In an uptrend, we want to break through the resistance, and we want that to become a floor. We want it to hold up. We want to break through the next one, and we want it to become the floor. It works the same to the downside. When it breaks a part of that floor, that support, it retraces back up. We want to see how it reacts here. In most cases, it's going to continue to fall down and find resistance. That's why we want most of our trades to stay in this momentum zone, because there's less resistance. Okay, the path of least resistance is towards the upper end of the chart. There's less resistance here. The bottom end of the chart, there's a ton of resistance. That's all it is resistance. So that's why we don't necessarily want to try and pick something early in the trend, because there's a lot of resistance. Now, there are times where taking a little bit more aggressive stance, taking a little bit more aggressive trade earlier in the trend can benefit. The risk to reward oftentimes will work that way as well. But the vast majority of time, we're just looking for those stocks and market conditions that are in the upper end of the trend. Let's look at sectors right here, because we have seen sectors also starting to weaken. We've got, when we see sectors, we've talked about this the last few weeks. For a few days there, we saw all of these with buy zones. Okay, now you can see what's happening. We're getting areas of the economy, sectors that are starting to weaken. And we've got a couple that are back into downtrend zone. Obviously, we know that technology is a part of that. Consumer services has also been a part of that. But today we're seeing a 1% or 2% bounce on these, and that could be some support that we need. Maybe the selling's over. Now you're getting buyers and new demand coming back in to sectors as a whole as well. Commodities, we look at gold. Gold is starting to weaken back down into this 382. Also, I talk about this a lot, but this is also a good visual representation of this. When you pull up a chart or a market and you see that it's right here, glance to see if it's approaching the 236, because it's getting ready to fall off the table, or it's getting ready to find some support and move this direction. But it's giving us, there's lots of indecision happening right here. And is it going to break down and turn into this? Is it going to turn into a larger downtrend? These are the decision point. Okay, and at the 236. So gold is sitting right there, at least on the 6-month time frame. The 1-year and 2-year time frame are going to be a lot deeper retracement, and you also want to use those for context. Go out and pull out a longer term time frame, because now what you're doing is you're going to say, oh, gold, now I've got a whole different perspective of gold. Yes, it could go back into this downtrend red, but it's in a really good strong uptrend, and it might even dip down to 211 range, find some support, and then move back up again. Okay, but it always starts with the shorter time frame. It's always going to start with this 6-month. That 1 year, I could say, oh, okay, well, now maybe it is going to find some support, but as of right now, let's sit tight. Okay, let's not add anything new. Let's maintain our stop. we've got one gold stock. We got stopped out of some of the silver ETF today. The gold stock is KGC, and that is what this one looks like here as well, but it's not stopped out. Our stop loss is below the 236 right here, giving it some time to have some volatility. Let me go into that 6 month. There it goes. So the 6 month, you can also see here, it's right at the support, 236, potential bottoming tail bar, but it's got, if gold keeps sliding, this one may as well. So we don't have to be overly emotional and say, oh my gosh, what is happening? We don't have to know what is happening. We don't have to know why. We're never going to know why anything is working, honestly. I'm baffled that every day financial media news finds things to talk about, because it plays a part, but it's almost never the reason. And it also becomes cloudy. What we want to focus on is, what is the price activity telling us? Are we in momentum? Are we getting potentially close to breaking down momentum? That means we need to get out of a trade if we're in it. This was our buy. This was our buy right here. Our stop, now we've been able to update our stop loss to a low point here. So it potentially could be a break-even trade. If it rallies, we can then adjust the stop loss as it's moving higher. This first retracement after the initial buy point oftentimes is the hardest one to ride out. I hate them. I hate riding out retracements. I think everybody does, because you never know quite what you're going to get, and it starts to create a second guessing scenario. Oh, I should have sold here, or oh, I should have sold here, or oh, should I sell now, or oh, should I wait to get stopped out? That's trading plan rules. Okay, if you're asking yourself those questions, then you need to ask those questions before you make the trade. And how do you ask yourself those questions? You follow the trading plan, okay? And you go through and you say, what's my setup? What's my time frame? What are my entry rules? Where do I place my stop? How do I exit? What are my risk management rules? Okay, these are a very simple process and questions to ask. Then when you're in the heat of the battle, you're not wondering what you're doing and running around in circles and making bad decisions because you don't know what to do at that point. The chaos sets in, and once we're in the middle of chaos, it's very hard to follow our trading plan. And even if we're getting stopped out, and even if we're selling positions, and even if we're taking drawdown, as long as we're following within the trading plan, meaning I've done this, I've entered, I've sold or not sold, I've got a stop loss here based on the number of shares. Okay, then I know what I'm doing and why, and that's going to be half your battle right there. Half the battle is knowing what you're doing and why. And are you trading? In this case, we're only focused on the stocks themselves. We're not even focused on options or anything having to do with that. We're just focused on what is the stock doing, and are we following a process that allows us to have an edge, and then we're managing our risk so that when that doesn't materialize, then we're out of the trade. No harm, no foul. We don't have to beat ourselves up. We don't have to, do anything. We just move on. Okay. And if you want to be able to follow along some of these trades a little bit more closely, we do have the Discord room in the Wheel Portfolio. There's a link at the bottom of each of these recordings. Now you can join us in there. And essentially, it's this process every morning, going through what do we own, where's our stop, why are we buying, why are we selling. What new stock are we adding in? What's our allocation? Are we 2%? Are we 2.5%? Are we 1.5%? Okay, essentially just following a trading plan for a portfolio and allowing some structure on the TradersPro methodology. I'm going to end on that note. I sure appreciate everyone's time and effort, and we'll see you next time. Thanks a lot. Bye now.